Property tax, new topic that we have to study, right? We know that there are various, mainly two types of properties, right? Two various or two separate leases, right? One is your residential property, right? The one in people reside. And the second one is your commercial property, also known as investment property, or can be called as investment property, right? The point is, any property, if you basically invest your money in that as an individual, we're talking about right now, all right? Any property, if you invest your money in that, okay, and you earn certain rentals from it, all right, that rental income is taxed under property income. Obviously, it's not just the direct income that's coming in, there might be some expenses. For example, listing expenses, right? Usually what happens is when you want to rent your property, and let's say when you're looking for tenants, you list your property to, let's say you ask the brokers to list the property in the market, and that has some listing fee, okay? So in that situation, yes, listing fee is a valid expense, which also can include, let's say, advertisement expense, which can also include, let's say brokerage fees, right? The point is that these are expenses that you incur before you've actually let out the property. That means the period when which the property is available for letting. And when you've actually let out the property, that is when you probably incur actual expenses, let's say water tax, council tax, repairs and maintenance, right? So all these expenses that you incur when you've actually let out the property, when the tenant is actually living in that property, okay? So that is a period when you have actually let out the property. And then there is third period. So for these two periods, expenses are allowed. All right. There's a third period where the landlord, for example, if I own the property, I'm living in that property. All right. That means I'm making residential use of that property, or I'm making commercial use of that property as an owner. Do you think those expenses will be allowed under property income? Guys, do you think those expenses will be allowed under property income? Yes or no? No. All right. Those expenses will not be allowed under property income. Why? Because if you're making use of that property, let's say you're making residential use of that property, okay, that means you don't have an intention to earn income from it. If you don't have an intention to earn income from it, look from the point of the government. If you're making use of a property such that you don't have an intention to earn income from it, that means you're not generating anything for me. As government, you're not generating anything for me, right? Because when you earn income, when you have an intention to earn income out of it, I will come and tax you, and that will be my earning as a government, right? But since your intention is not to earn from that property because you're already living in it, it's your property and you're living in it, therefore I will never allow you to deduct your expenses. And in fact, what will you deduct your expenses from? You don't have any income, you don't have any top line, okay? So residential use or commercial use by the owner, commercial use can come under different, let's say trading income or any other particular income, but residential use certainly not. You cannot deduct any expenses during that period from the property income, right? Now, let's try to understand what other expenses there could be. So income, calculating the income is very basic, right? Remember one thing, in the world of accounting, we know that there are two bases, okay? And there's one basis that we use to prepare a financial statement, which is called the accruals basis or the accruals concept, right? Over here, both accruals in the world of taxation, Both accruals and cash basis play their own role. Now, when it comes to property income is taxed on cash basis up till the annual rental income of 150,000 pounds. All right. Up till an annual rental income of 150,000 pounds. Do you have an option to, uh, you know, tax it on accruals basis? Yes, you have an option. But if, the default basis is cash basis, all right. As and when you cross 150,000 pounds in rental income per annum, you will have to switch to accruals basis. All right. Now your income will be taxed at accruals basis. All right. You understand? Guys, do you get this part? Because I'm going to move on to the expenses now.
Yes.
Sir, accrual basis means?
Accruals basis means whenever the income is accrued, you have to pay tax on it. Cash basis is whenever you receive the money, receive the rent, that is when you pay tax. If you haven't received it, you won't pay it.
Okay.
All right.
Okay. Oh,
Now it says property expenses are of two types, which certainly is not just in property income, it's in all incomes. Allowed expenses and not allowed expenses. That means expenses that you have incurred and are valid for tax purposes to be deductible. And expenses that are not allowed are actually expenses that you've incurred, but you cannot deduct them from your profit and loss statement. Do we have any such thing in accounting? Probably not. We do have cost being incurred, which is probably expensed out or capitalized. Yes. In the world of accounting, that these are two things that we know about. In the world of taxation, there could be expenses that are allowed and expenses that are not allowed. Expenses that you've incurred and will be deductible will be allowed by HMRC so that you can deduct from your income are valid deductions so that your profit can reduce and so will the tax. And there are certain expenses that you're not allowed to deduct. Okay. So can you please go through this list? But before going through this list, now this, I just want you to ignore this. All right. Ignore this for now, which we'll discuss later. And ignore this part, which I'll tell you. Just go through this. Before that, always remember it's a general rule of thumb for any income. Property income is the first income that we're studying. After this, we'll have employment income, trading income, right? We'll have pension and all that. Remember one thing. Expense will only be allowed if it's wholly and exclusively. That means there is no dual nature in it and there is no ambiguity in it. All right. If it's wholly and exclusively incurred for the purposes of the trade, in this case, the trade or the business is what? To rent out property, right? And to earn rental incomes from it, right? So in this situation, if the expense is being incurred wholly and exclusively for the purposes of earning that business income, it's allowed. If there is an if there's an element of ambiguity or element of duality, all right, which is called a duality test and a remoteness test, basically. These are the two tests that the HMRC conducts. Any expense that has a dual nature, that means personal and business both, and remoteness test basically means that what relation does the expense, the nature of the expense has with the nature of business. The relation of the nature of expense with the nature of business. I purchased gold. I rent out properties. I purchased gold. Now, the purchase of gold, I'm deducting it from the property income. Does it have, does it have any relation? You understand
no.
what I'm trying to say? Remoteness test basically tells the nature of expense, how to what close proximity is the nature of expense to the nature of business. All right. So these are two tests that HMRC conducts for you to for in order to determine whether an expense will be allowed or not. Simple. Now I want you to read this, and then we'll move on to the Lower part. Interest paid on loan acquired to buy the property. Will ignore this totally right now. I'll come to this later on. Okay. All right. Now you have repair, maintenance, renovation, decoration, insurance, right? Renovation, decoration is basically, called staging usually, right? The staging expense, water and council tax, and this is, guys, only if the landlord is paying it. If the tenant is paying it, then obviously it's not going out of the landlord's pocket. We're studying for the landlord. Okay. Agent commission, advertisement, legal charges, rent paid, right? Rent paid is when you, um, in fact, I'll explain this example later when we study about the premiums, right? Pre-trading expenditure. What do you mean by pre-trading expenditure? Pre-trading expenditure means when you actually have, before starting or before actually renting out the property, which I told you about, right? You need to incur some pre-trading expenditure so that at least your property becomes rentable. You understand? Okay. Capital expenditure related to plant and machinery is also an allowed expense, not related to the building or land, only related to the plant and machinery. All right. Replacement domestic items relief. Now, what exactly are domestic items? Domestic items such as, your oven or your TV, your furniture, or the over and above fixtures, that are not part of the, they're not essentially part of the building structure. The other fixtures, right? In residential property. So this is, remember, because it's a domestic relief, so it's only for residential properties. All right.
Sir, can you tell pre-trading expenditure again?
Pre-trading expenditure is when you've actually incurred some expenditure before starting to rent out the property. Let's say I talked about listing fees. That's a pre-trading expenditure, right? That means
Oh, okay.
you haven't started renting out the property yet, and you need to incur some expenditure in order to make sure that your property becomes rentable. Okay.
Okay, okay, sir.
Now, for domestic items, there's a certain amount that can be allowed as an expense, and that certain amount includes replacement cost less any disposal proceeds from the previous item that you already had. All right, so let's say I had a Samsung LED, let's say 32 inches Samsung LED. All right, let's say this cost me 2,000 pounds. All right, now let's say I buy a new LED, which is this time 54 inches. All right, and this is also Samsung LED. Okay, but this cost me how much? Let's say 5,000 pounds. If I'm replacing a 32 inch with a 54 inch, is this replacement cost correct?
No.
No. Why? Because there is an element of improvement. All right, I'm upgrading my previous asset. Okay, the correct replacement cost would be the cost of buying a new 32-inch Samsung LED. Let's say now it's 2,500 pounds. A new Samsung 32-inch LED is worth 2,500 pounds. All right, that is your replacement cost after deduction of, obviously the allowed expense would be after deduction of whatever you've scrapped it for, or let's say you've sold it for, let's say 300 pounds. Let's say I've scrapped it for 300 pounds, right? So the relief for domestic items would be, in this case, 2,200 pounds will be a deductible expense from my rental income to calculate the profit on property or property income. You understand this, guys? Do you get this element or not? All right, Jasmine, what about you? Is she with us? All right. I want you to read this part now. I already told you what not allowed expenses are. Expenses that you've incurred, but they will not be allowed from your, they will not be an eligible deduction from your property income P&L. Okay. Capital expenditure related to land buildings, which I already told you earlier when I was talking about plant and machinery. All right. Estimates and provisions, for example, provision for doubtful debt and depreciation. In the world of taxation, estimates are the most hated expense. Why? Because companies or businesses or individuals, they tend to extrapolate so that they can claim higher expense and against a lower profit so that they'll have to pay a lower tax. Okay? And cars are also an expense that will not be allowed because cars have dual use, both business and private. And it's hard to bifurcate the business and private use. All right? Usually it's based on miles, right? But in this situation, cars are not an allowed expense. Okay? Now, next thing, premium on property. Let's try to understand this. Guys, just give me, okay, now, right now we still have time in the Azan. So, now, premium on property. What exactly is premium on property? Let's try to understand this. Usually, when I go out, usually when a tenant comes to me and asks me to let out my property to them, all right, I don't give them the permission to play with the structure of the property. They can't mess with the structure of the property. Yes, they can bring in their furniture. Yes, they can mount up their TV where the mounting place actually is. Not that they change the entire wall and they change the mounting place and all that. They can mount the TV wherever the place is, right? They cannot, like, you know unwind the sink in the restroom and change its place, or unwind the kitchen area and change its place and all that stuff. They cannot mess with the building structure, all right, the property structure. But usually, and this usually happens in commercial properties, that obviously a commercial use may be different to what the property is currently giving you. All right, what the property currently allows you, the structure of the property currently allows you, the commercial use could be different than that. So when I get a tenant on that, right, they usually ask for my permission, and obviously we document it on an agreement, that they can change the structure of the property as per their business needs. So they can install, let's say, movable walls, or they can install some fixtures over the wall. They can, do that hammering in the wall, and that they can, put in the nails, and they can hang their art and all that stuff and whatever they want, right? They can mess with the structure of the building, not the outer structure, but the inner structure that's movable or that's changeable. All right, not like demolish the entire building and then reconstruct. I'm not talking about that. Just the movable items that can be changed, or items that can be basically extracted from somewhere and fixed somewhere else, right? Now, in that situation, obviously, I would ask for a premium, because that's not exactly temporary changes, you can call that. I'll ask for a premium. Why? Because I need to be compensated for that particular change, because there might be an instant where obviously I'll ask them to put all the things back as they were after, at the end of the lease term, yes. But I know that changing would bring in, when they change the property, they won't put it as it is. They cannot, right? The way I staged the property, they cannot do the same. Okay. And due to various other reasons, so for example, this is called a risk premium, let's say, to cater to the risk that I'm taking by allowing them to change the property structure, right? So you can call it whatever you want, but it's basically a premium that I charge on my property if the tenant wants such permission. All right. And that premium again is taxable. That premium is taxable on cash basis. That means the moment I receive the cash, it will become taxable. Now the point is, how is the entire premium taxable? No, there's a formula for it. All right. So let's say the premium I received was £100,000. Now this is a formula that you'll have to remember because it's not given to you in the tax rate sheet. Okay. Premium into n minus 1 into 2%. And this is treated as a deduction. Whatever is left is called taxable premium. Let's say, and what's this n over here? Or you can also call it simply the lease term. Right? Let's say the lease term is 15 years. All right. So can you do the calculation for me, please? 100,000 multiplied by 14 multiplied by 2%. Should turn out to be 28,000, something like that. Yeah, 28,000. All right. So that's 28,000. All right. So the remaining taxable premium is 72,000. Yes. And this will be basically added to the property income and will be taxed under the non-savings head. Property income comes under the non-savings head. All right. Don't forget the basics. Now let's move on to Excel and let me explain you one more thing on this. So as per our example, the premium was how much? 100,000. Lease term was
15.
initially 15 years, right? So premium, and I'm receiving the premium, okay, is 100,000. Formula turns out to be premium into n minus 1 multiplied by 2%, right? And you're left with the taxable premium. All right. Now, I just want you to focus on these two figures over here. All right. What if the lease term increases? What if I bring it closer to 50? And what if I do this? And what if I do this? It's gone. No amount will be taxed. No amount coming from premium will be taxed under property income if the lease term is 51 or more. I'll repeat, and I've showed this to you, I'll show it to you again. The closer you go to 50, more amount becomes deductible and lesser amount becomes taxable under the property income. There's a reason behind it, I'll tell you in a bit. Okay. So let's go back, let's say 35. So you still have some deductible amount and you have some taxable amount. Let's say 15, right? You have more taxable and less deductible, right? When you go about 10, you have again more taxable and less deductible. What about, let's say 48? More deductible and less tax. The closer you get to 50, less amount becomes taxable under property income. Does that mean that this amount will never be taxed? No. It will be taxed. Where? I'll tell you. So let's say 50, minimum amount will be taxed under property income. And as soon as you agree to the lease term 51 years, it's gone. No amount will be taxed under property income. Why? Because HMRC thinks it's not that I'm not like it's not actually the thinking. This is what the economics of the transaction says, according to HMRC, that if the lease term is 50, that means more than 50, not 50, more than 50, not more than equal to 50, more than 50. That means 51 or more. Okay. In that situation, the landlord has actually disposed of the property. HMRC treats it as if the landlord has disposed of the property, and whatever the premium that guy has received is actually disposal proceeds on the property. And whenever you dispose of a asset of capital nature, this is taxed under capital gains tax, which we haven't studied right now. If we study later on, it's part of our syllabus. All right.
Sir, this list term
Huh?
based on years, correct?
Yeah, lease term is
50,
based on years. Uh-huh.
based on years, contract will be there like that.
No, no,
51 for 51
you
years.
will be given to you will be given the lease term in the question.
By logic, like that, any contract will be there for 50 years.
Yeah, 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 there will be a contract. There will be
Uh,
a contract between the landlord and the tenant. There will be a contract. That contract will tell what is the that contract will tell about the lease term. Okay.
okay, okay.
This is a concept that we can easily grasp, right? Let's look at another angle on this. This is the case where you own the property, that means the landlord owns the property, and you have let it out to a tenant. What if you have you're basically the tenant and then you've subletted the property? What happens then? Any idea? Let's say you have paid a premium of, let's say, 25,000 on a lease term of 30 years. All right. Whereas you have received a premium of, let's say, 20,000 on a lease term of 20 years. What happens then? Any suggestions?
We can take both and adjust.
How? You are uh, basically, okay, I'll draw a diagram and I'll show it to you. Okay. Now this guy is the landlord. This guy is us. All right. This is, let's say, this is me. Okay. And you're obviously doing my taxes. Okay. And what I've done is I've actually sublet. So this landlord has let me out the property and I've sublet it. So do I own this property? No, I don't own this property. Okay. Now in this situation, this guy, obviously I paid a premium. Let's say I had to modify the property and then I had to sublet it. I paid a premium to the landlord. All right. And then I also allowed the subtenant or the second tenant in line to change the property however he wants, and I basically took a premium on that as well. All right. My question to you is, how will I treat this as, or how will I do the taxes over here? What will be the taxable amount? First and foremost, Premium received. So I'll just copy this down. All right, 25,000 based on this, and you get a taxable premium, right? But the point is this the net taxable premium? No, this is basically in this case the net premium because there is some deduction as well. What would that deduction be? Let's see. So how much premium did you pay? In this situation, how much premium did you pay? 20,000. And for the, sorry, how much premium did you pay? 25,000, right? No, I've done the wrong, I've taken the wrong figure, sorry. I should have taken 20,000, my bad. No. So this will change to, all right, now this is correct. Okay. So the premium that I have paid, I need to do the accounting for that as well. I need to account for that as well, right? Same formula will be used here. All right. Now for the landlord, for this guy to whom I've paid the premium 25,000, taxable premium of 10,500 is valid for him, right? The point is these two are different lease terms. This taxable premium is for a 20-year lease term. On the other hand, this premium that I've paid is on a lease term of 30 years. So I cannot deduct the entire 10,500 from 12,400. I need to prorate it. All right. Multiplied by 20 divided by 30. So I will only deduct 7,000, which is an allowed expense for me. And this becomes my net taxable premium. You guys get it? What if it's 7,000? How did you get 7,600? This multiplied by 20 divided by 30. All right. Now, net taxable premium of 5,400, right? What if, let's say, over here, I don't sublet the property, all right? Let's say I don't sublet the property, okay? But I'm using the property, let's say, for my business or for my trade. And I've paid a premium of how much? 25,000 on a lease term of how much? 30 years, right? In that situation, the taxable premium turns out to be 10,500. Yes. In that situation, the taxable premium turns out to be 10,500, right? I'm not subletting the property. I'm using it for my business. So technically, since I'm using this for my business, this premium that I've paid should be a tax allowable expense, right? It should be an allowed expense. Yes. Now the question is, should it be or will it be allowed in the first year of business, last year of business, last year of lease term, first year of lease term? When? When do you think it should be allowed? It will be amortized over the lease term. All right. It will be amortized over the lease term. Lease term is 20 years, whereas this premium over here is 10,500. So in that situation, 10,500 divided by 20. So 525 allowed expense per annum. Okay. I hope you guys get this.
Yes, sir.
All right. If you want to make some notes, do that. And then I'll move on to the next part of this topic. Now, rent a room relief. Okay, this is pretty simple. This is the Airbnb model. All right, you have a furnished home, a residential property, not a commercial we're talking about over here. All right, a residential property. All right, you have a residential property, it's furnished. You have one room in it which you want to rent out. Yes, this is how Airbnb started, right? Residential home, and you want to rent it, and that room is furnished. Okay, in that case, whatever income you earn, that's one thing. All right, whatever income you've earned, that's one thing. This basically, the relief is on the expenses. Sorry. So this relief over here is on the expenses. How? Let's see. So let's say I have a residential property that in which I want to rent out one room. And the rental income per annum for that room is, let's say, 6,000 pounds. All right. You have two options. When you're deducting the expenses, you can either deduct the actual expenses or you can opt for a rent a room relief. Now, what's the difference? Rent a room relief. Let's say the actual expenses are 5,000 and rent a room relief is fixed by HMRC at 7,500. All right. So obviously, when you think about claiming the expenses, will you go for the lower one or the higher one? It's not like that you've actually incurred 7,500. What you've actually incurred is 5,000. All right. So my question to you is, which one will you consider, 7,500 or 5,000?
7.5.
Exactly, the higher one. All right. And this is what rent a room relief allows you to do. Expenses can be claimed at higher of actual or rent a room relief, right? Which is 7,500 fixed, right? So in this case, you will go for 7,500. Now, a lot of students have this misconception that this will create a property loss. Can we have a property loss? Yes. I'll tell you how to work for it later on towards the end. But this will not create a property loss. Why? Remember, property loss can only be created by actual expenses, not by reliefs given to you by HMRC. All right. So 7,500 in this situation will be restricted to 6,000 and your property income will turn out to be zero. What if the rental income was, let's say, 10,000 and actual expenses were, let's say, 7,000, whereas rent a room relief is fixed at 7,500. Now, yes, you can deduct 7,500, which is higher of the two, and the remaining will be your property income. If the actual expenses are higher, you can certainly deduct the actual expenses. All right. You have a choice. It's not like you'll be restricted. You have a choice. Okay. You guys understand this?
Yes, sir.
Are you sure?
Yes.
Perfect. Just take some notes and then we'll continue. Jointly held property between husband and wife. If, let's say, the husband has, if let's say the husband and wife, all right, they pool in funds to own a property. Yes. Now that's possible, right? If you see over here, it says that the default ownership is how much? 50-50. Right now, it does not depend on what your income is, I would say. Okay, we'll consider right now whatever the income is does not matter. So default ownership is 50-50. That means if you plan to rent out this property and you plan to earn income from it, 50%, 50%, right? If you actually claim or you elect for actual ownership, this can change. Let's say the wife has 60% ownership and husband has 40% ownership. This can change. All right. If you actually make an election to basically claim your percentage of ownership in your property, the husband can claim 40%, wife can claim 60%, 70-30, 30-70, whatever it is. It can change. Okay. As per the actual ownership. Now, the point is, there's a planning element over here, which you need to understand. What's that planning element? Why is it a concern that the default person, let's stick to the default or let's claim the actual? Okay, fine. If it's actual, what should it be? Should you have a higher share, or should I have should I have a higher share? Right? All these things, why do they matter? Or in which situation would they matter? It totally depends on your income. All right. Why? Because right now, exactly. Okay. It depends on your income. Let's say the husband has a lower share in the property, 40%. Wife has a higher share in property, 60%. But the income of the husband is higher. Let's say the income of the husband is 35,000 per annum. And wife, let's say, is earning 10,000. All right. And let's say the rental income that will come from this, guys, I want you to be very attentive in this example. Okay. The rental income that is coming from, or that will come from this property is, let's say, 10,000. All right. Now, if we stick to the default percentage, that means 50-50. Default is 50-50, right? So in this situation, 5,000 over here and 5,000 over here. Who's paying a tax at the higher rate now? Husband, because his total income is now 40,000. I'm assuming this as taxable income right now. Okay, forget about the personal allowance. All right, I'm just assuming this as a taxable income. So 40,000 taxable income. In this situation is just 15,000, right? Case number 2. This is allocated as per actual percentage. That means this 10,000, I'm doing it over here in white. Actual percentage would be 4,000 and 6,000. That means the difference of 1,000 previously was being taxed at 40%. Now that difference over here is being taxed at 20%. So are you, as a family, are you saving 20%? Yes, right? As a family, you're saving 20%, right? Because wife is a basic rate taxpayer, and just because now rental income is coming to me as well, I have become a high rate taxpayer. All right. You guys understand this? So this is basically, this is just one example. There could be various examples. All right. So this is one example on how you can plan for taxation when you have joint ownership along with your wife in the property. All right. Just note this down and then we'll move on to the other part. Now, there's one area that you need to know about, which will come later in the pension topic as well. FHL, furnished holiday letting. All right. This mainly is like a guest house or a hoteling business, right? Where you buy a commercial property and you let it out to different tenants who are living for a short period of time, not for 5 years, 10 years, 15 years, right? But for a short period of time. All right. There are different reliefs if your property qualifies for FHL. Okay. Now, over here, it says capital allowances are available. Capital allowance, if you've studied F9, financial management, you would know what capital allowance is. It's basically tax allowable depreciation. Does the tax department have its own depreciation method? Yes. Does the tax department allow accounting depreciation? No. All right. Income qualifies for relevant earnings, which I'll tell you when we study pension. Capital gains tax, rollover, entrepreneurs relief. Entrepreneurs relief, the name has basically changed now. All right. So I'll tell you when we study the relevant topics of capital gains tax. Okay. Now, in order to qualify for an FHL, because you see that there are multiple reliefs on it, right? So if you're in the letting out business, if you're in the business of renting out properties, you would probably want your property to qualify as FHL. But the point is there are certain conditions attached to it. Okay. Condition number one, your property should be situated in UK. Your property should be in UK. That's one. Second, whatever property you have, whatever accommodation you have, it should be available, not actual, available. Remember I talked about I talked about two periods when I was starting this topic. Available for letting and actually let, right? It should be available for letting at least 210 days in a year. So that essentially becomes 7 months based on 30 days, let's say, right? 30 days a month, it becomes 7 months approximately, right? In a year, it should be available for letting. Second, this is the condition on actually let, when the property should actually be let out for at least 105 days. How many? 105 days during the year it should be actually let out. So if it's available for 210, half of the days it should be actually let out. Okay. So if you remember 210, automatically half of it, you should actually let it out. All right. That's two conditions. And the third condition basically differentiates a residential letting from a commercial letting. What's that? Longer term occupation, which I'll tell you what it is, I'll explain, should not be of more than 155 days in a year. Longer term occupation should not be of more than 155 days in a year. What exactly is longer term occupation? One longer term occupation, or one, you can call it long term occupation, is equals to 31 days, one tenant living in your property continuously. That's one long term occupation. That the person has occupied the property for long term. That's why it's called long term occupation. The person, the tenant, has occupied the property for long term, and this equates to continuous 31 days in a month. Your maximum, you have 31 days in a month, right? You understand? So if it should not be more than 155 days, that means right? Same guy, same tenant should not be in your property for more than 5 months. You get it? Is there any confusion? Yasmin, is there any confusion?
No.
All right. Now, coming to the restriction of finance costs, and this is why basically if you remember when we were studying allowed expenses, I cancelled out one point on interest cost, right? This is what I have to explain to you. This applies on individuals, number one, applies on individuals, not on companies. Applies on residential properties, not on commercial properties. I'll repeat, it applies on individuals, not on companies. Applies on residential properties, not on commercial properties. All right. What applies? Let's try to understand. And I believe it's a very valid restriction. It's a restriction on finance costs. Name, yes, to some extent it suggests something, but we'll try to obviously get into the detail and we'll try to understand what it says. Now, back in 2008, there was a mortgage crisis. There was a crisis in the mortgage market, which basically led to crisis in the property market. So, there were a lot of huge investors, banks, and a lot of funds that were created so that they can invest the money in property, right? And why did they want to invest money in property? Because people were coming in. People had probably a lot of money to commit to the future, so they were coming in and they were taking mortgages, right? And from mortgages, there came subprime mortgages, and the subprime mortgages were sold to the investors. And there was a total, a total, what do you call that? What effect is it called? The, the I forgot the name. How come I forget? How did I forget the name? All right, so it was basically uh, a, a huge effect, like one after the other. What do you call that? The blocks fall one after the other. I forgot. Why? How did I forget the name?
Domino.
Okay, sorry.
Domino effect.
Domino effect. Yes, thank you. All right. So it created a domino effect. All right. So first, obviously, the initial guy in the food chain, in the investment chain, who was a retail investor, let's say, right? He invested a lot of money in subprime mortgages and different types of mortgages, right? And banks obviously were lending a lot of money to people with zero credit worthiness or very low credit worthiness. Okay. And in that situation, obviously, those who didn't have the right credit rating, they obviously defaulted. And when they defaulted, there was a total domino effect because one after the other in the food chain, they collapsed. All right. I would say, and this is my understanding personally, I'm not saying that this is why the law came into existence. This is my understanding only. Okay. I would say that because of this, a restriction came in. And there's one more reason. You know, individuals who have um, high credit rating, right, or a good credit rating, they tend to take loans, borrowed money, not their own money. If it's borrowed money, that means you don't have. Basically, it's something that you cannot afford, right? It's not within your domain. You cannot afford it. That's why you borrowed the money and you've invested it. So they used to play on borrowed money and they used to invest borrowed money into properties, and then they used to flip the properties, which ultimately created, um, you know, uh, I would say, a bubble in the property market, leading to a significant rise in the property prices. And we know that London, which is the center of UK, right, has one of the highest property prices in the world. Yes. And we also know that these developed countries, they have access to money when it comes to investing in property. They have access to banks' money, they have access to funds' money, they have access to public's money, they have access to a lot of money when it comes to investing in property. Obviously, if residential property becomes unaffordable, then how will you reside in that property? Only rich will own the property, and a middle class person, it will become very hard for him to own the property, right? Which is obviously against social economic situation, right? So in that case, and I believe because of that reason, HMRC came up with a solution. Okay, HMRC said, let's do one thing. If you as an individual take some loan at, let's say, 5% and invest it in a residential property. As an individual, take a loan and you invest in a residential property, right? Now you have let out this property because you have a relevant income coming in, you have a rental income coming in, and so rental income is taxed, right? No, I'm not saying that you've taken a loan and then you're residing yourself. That's in that situation we already discussed that there are no allowed expenses. All right. Over here, the thing is that let's say you have let out the property and someone else is living in it, your tenant's paying you the rent. All right. Now, technically, this interest, right, should be an allowed expense, right? This interest should be an allowed expense, right, guys?
Yes, sir.
Just logically speaking, I'm not getting into the details of what tax says. Logically speaking, this should be an allowed expense, but HMRC restricted this. All right. In Finance Act 18, this new law came in. At that time, it was 50-50. That means 50% of the finance cost will be allowed as an expense, and the remaining 50% will only attract a 20% income tax relief, just like just like in the case of transfer of personal allowance. All right, just like you remember the case of transfer of personal allowance, there's 20% tax relief, tax credit, you can call it. Just like that, you will receive a basic rate tax benefit on the 50%. Then in Finance Act 19, which was last year, they made it 75-25. That means 75 will be restricted for basic rate tax relief, and only 25% of it will be allowed from the property income P&L. Now, in Finance Act 20, they've changed to 100 and 0. That means they've restricted the entire 100% amount of 5,000 at basic rate of tax. And this will be actually a tax credit. Tax credit is basically deducted from your income tax liability, right? Tax credit is deducted from your income tax liability. You understand this? Guys, do you get it or not?
Yes, sir.
Are you sure? Okay, note this down. I repeat, this 5,000, whatever interest expense you have on such a financing is not an allowed expense now. 100% of this finance cost will attract a tax relief at basic rate of tax, which is 20%. Okay. It will be deducted up when you're calculating the tax. Once you've calculated the entire tax, it will be deducted as a tax credit, right? Just like we discussed in transfer of personal allowance, 1,250 and 20%. Remember? Similarly, over here, this will be 5,000 into 20%. Interest cost or interest expense into the basic rate of tax. So this £1,000 will reduce your tax liability. It won't be treated as a deduction from your property income PNL or anything like that. It will basically directly reduce your tax liability. You understand? All right. Now, one last thing. Property business loss. Loss arises when you have expenses more than the income, right? Simple. That is when loss arises. Now, if the loss arises on one property, remember you have to aggregate the profit and loss of all properties first. All right. Add together profits and losses of all properties. Now, see if you're getting a net loss on all properties. This aggregate loss obviously will not be assessed for tax in the current year and will be carried forward indefinitely and utilized against future property income profits. Okay. Whenever you get a future property income profit, it will be utilized against that. And it's indefinite, by the way. All right. You guys get it?
Yes, sir.
Let's look at one small thing and then we'll end the class. Interest income. Now we know about this, that first 1,000 pounds will tax at 0% for basic taxpayer. We know about this and we know about this, right? And we also know about this, the fourth point. Yes? I want you to read the last 3 points and try to figure out if it's making sense. Otherwise, I'll explain you. I'll explain you what this is. Have you guys heard about withholding tax? Has anyone heard about withholding tax? Withholding tax is basically tax deducted at source. All right, just a second. Usually what happens when you earn your income, you tell HMRC what you've earned. And that is when they collect tax. You tell them through your return filing. You file your returns, and that is how they get to know that this is how much you earned, and they'll collect tax on it, right? Tax deduction at source means the moment you are collecting your money, it could be trading income, it could be employment income, mainly it's employment income, right? Or let's say interest income in this case. The moment you go and you stand in the line to get your money, HMRC will walk alongside you. All right. So let's say in this case, when there was no tax deduction at source, you received 1,000 pounds in your pocket. You told HMRC that you've earned 1,000 pounds and they asked for 20% tax on it, for example. But when it's tax deduction at source, they won't let you keep 1,000 pounds in your pocket. They'll deduct 20% from it first, and the remaining amount can go in your pockets. That's tax deduction at source. You guys understand the difference? Guys, do you get it or not?
Yes, sir. Clear.
All right, perfect. Which part, Hafsa? Which part do you want me to repeat? All right, I'll repeat. In usual circumstances, 1,000 pounds you get in your pocket, right? And Once you get 1,000 pounds in your pocket as your income, you go up to HMRC at the end of the year, at the end of the tax year, also known as fiscal year, right? And you tell them this is how much you've earned, and they'll tax it, and they'll ask for 20%, right? Tax deduction at source, on the other hand, is what? You go and collect your money. While you're collecting your money, right? The moment you're collecting your money, HMRC will come and takes, they'll take 20% away from you right there and then. At source, source is where you're basically getting your money from. Let's say, for example, employment income. The employer, your company, will deduct tax on your behalf, and the net amount they'll pay to you, they'll submit the tax amount to the government, and they'll pay the net amount to you. That's tax deduction at source. Okay. Exactly. It's basically pay as you earn. Exactly. You're right. Pay basically is a type of deduction at source. Got it? That's great. All right. So this is it for today, guys. I'll see you in the next class now. We'll study the pensions topic.